So we are starting the panel with the moderator, Mr. Jingdong Hua, on accessing the opportunities in emerging markets. Thank you.
Thank you very much. If I could ask my fellow panelists to join me as I introduce them to you. So we'll start with Mrs. Janet Hall, Principal Investment Specialist of the Asian Development Bank, a very esteemed institution. We have to her left Mr. Kuping Yang, CEO of Inventus Investment Holdings, an expert in China's PE landscape, and an author of very popular books on Chinese private equity. To his left, we have Mr. Shankar Nayaranan, Managing Director of the Carlyle Group. Next, we have Mr. Igal Valiev, President of AmCham, Azerbaijan. He told me, as a matter of fact, it's more of an international chamber of commerce, and then Managing Partner of Ernst & Young Holdings for the CIS. And last, certainly not the least, my good friend Andrei Kusvik from the EBRD. Andrei, if I could just caution you, don't move too much because you are at the precip on the other side. Don't fall. I have been told by the host that we have a hard stop at 5:45, so we only have 44 minutes going. So I just want to urge the panelists to be succinct. But let me first of all thank SOFAS and KIC for your invitation to attending and speaking at this very important summit at this interesting time. And let me also say that I'm glad to see ISC is your friend and partner with many of the clients and the GPs and investors in the room. And certainly we have alumni, former ISC, and future alumni like Su Joy, who will be the inaugural CEO of the Indian Sovereign Wealth Fund. We are very proud. But my message to you, don't steal from ISC anymore. We need people too. Now, before I hand over the floor to the panel, over the past 6 days, I have been attending three conferences. I attended the Mike Milken Institute conference in Singapore, Asia Summit, followed by the Singapore Summit before coming over here. So let me connect back to the first session, which is macroeconomic outlook, by sharing some of the takeaway I have had in terms of the global drivers of economy. And I have to say, although in Asia, when the question was posed, do you see glass half full, half empty, most people reluctantly said half full, but it was not very convincing. And I would say that from my takeaway, there are four underlying economic drivers that provide continued uncertainty into the future. Yeah? The first is demographics. And I have to say this is quite interesting. You probably don't know that it took Korea 20 years for the birth rate or for the household for women from 5 children to 2 children. But it took 130 years in UK, many decades ago. That's the accelerating demographic situation. And what that will do is that the expansion of global workforce will eventually succumb to demographic inevitability. According to McKinsey's study, the projected fall in workforce could cut global GDP growth by 40% in the next 50 years, with the only bright spot in Africa, where it is projected population will grow from about 1 billion to 4 billion, with average age in countries like Nigeria around 20 years old. So that's certainly a bright spot. The second driver is the credit is not it used to be. In the past, all the way till the global financial crisis from the 1990s, dropping inflation and with a accommodative credit has stimulated global growth. But since global financial crisis, with global drop in interest rate, and for a while we thought negative interest rate is just an academic theoretical curiosity to a reality in Japan, in Europe, this QE has really not provided that stimulus, while the credit growth has been incredible. So that is a big question mark. The third is digital revolution, artificial intelligence. This is a big disruptor. The aggregate impact, good or bad, we don't know yet. Yeah? And very quickly, the fourth one is geopolitical uncertainty. This overall stagnated middle class in OECD country, driving anti-globalization, anti-multilateralism in the world. At the same time, you have number of major terrorist incidents, according to McKinsey, rising from about 198 incidents in the year 2000 to about 1,442 in 2014 and 1,417 in 2015. So with this global economic background, let me connect a paradox also. That is, there is $36 trillion earning less than 1% yield, with a significant portion earning 0%. Meanwhile, in emerging market, there is a $1 trillion financing gap every year. Why they are not connecting, right? As Jin Yong mentioned, in Indonesia, 25% lack basic access to electricity. In sub-Saharan Africa, outside of South Africa, that number is 80%. So the need for basic infrastructure, which is a foundation for economic growth, is compelling. Another factor is with governments so over-indebted, the future of development finance has to be led by private sector. And therefore, the panel here is really representing a very seasoned group of practitioners. We're really fortunate to have all of them. Now, given the shortage of time, while they are making their introduction, I'd like to pose the following three questions so that they can also incorporate into their answers. And meanwhile, hopefully we would still have 5 minutes at the end for the audience to ask questions. So the three questions are, is there alpha in emerging market? In IFC's terminology, emerging markets are countries from Azerbaijan to Zambia, from A to Z. It's about 120 countries. Yeah, it's not the higher middle income country that people are talking about. Is there alpha? Is that alpha a function of the gap between perceived and real risk? And this is the first question. The second question is, you as an investor or a practitioner in emerging market, what are your top 3 challenges in making investment decisions in emerging market? And the third is, how can government and multilateral institutions like the EBRD, Asian Development Bank, and IFC help to make emerging market investment attractive to private sector investors like you? So let me start with Janet from the Asian Development Bank.
Sure.
And please be succinct, between 3 to 5 minutes.
Perfect.
Thank you.
Thank you, Zhengdong. So ADB, as a multilateral, its experience in the emerging markets is primarily through its private equity funds, where we've done about 60 funds over the last 20 years, investing throughout the Asian region. This has allowed us to touch sectors that are close to us, which are the financial services, the infrastructure sector, agricultural, healthcare, as well as education. And so in doing so, it has obviously provided us with attractive investment opportunities, as well as co-financing opportunities. We've also used our relationships with the fund managers, as well as pension funds, to establish sector-focused funds like the healthcare fund that we did with OrbiMed for about $325 million. We also recently did a dedicated clean energy fund with Robeco and Oryx of about 450. And then more recently, we established a $1.5 billion infrastructure fund with Japan. So these are more or less the ways that we look in order to be able to tap into the investment market.
In the previous panel, our Italian friends was promoting growth fund. And this is exactly what we did in China. We invest in private companies in China. We started investing in private companies in China at the southern part of China, in the manufacturing sectors. And along the years, we moved on to the central part and the western part of China. We're taking minority stake in the Chinese company in the second tier and third tier cities. And we are very proud about our investment because we created so many job opportunities in those smaller cities. We created so much of economic activities in these cities. And in general, we exit our investment via trade sales and secondary sales. After the launch, I think we have this idea about we did it before and we can do it again. So what we are trying to do for the last 6 months, we are planning a Russian CIS fund. We want to link the Russian and CIS region to China with our investment experience in China. We want to create a specific fund just for this purpose. There was a question about also where to start One Belt, One Road. My answer would be from Russia and CIS until we reach Turkey. So this is how we should start the One Belt, One Road from the Chinese point of view. Thank you.
Hi, I'm Shankar. I co-head for Carlyle its growth capital and mid-market buyout business for Asia. I've been doing private equity since 1993. I tend to be conservative. I've still not lost money on a single deal since the last 23 years. Just in terms of accessing opportunities, I won't speak about the venture part of the business, but more about what I've been doing all these years. See, companies tend to be like humans. So if you're writing a SAT or GMAT exam, you keep getting 500, you'd never get 800 when you go write the exam. So for us, track record of profitability becomes very, very important. There are certain sectors where Carlyle can make a difference. There are certain sectors where IFC could make a difference. So I think you should be careful about the sectors you choose. A person working in a construction site does hard work. He probably doesn't make much money. So Carlyle, with its network of relationships, investee companies, body of knowledge, can make a difference to certain types of companies. So we tend to concentrate on those kind of sectors. The other thing in emerging markets, which is absolutely vital in success of an investment, is 2 subjective factors. And I think each of us should take ownership of that, because that is the way we can change each of these countries. One is the drive, hunger, ingenuity of the entrepreneurs, because eventually you're backing an entrepreneur or the management team. But above all, the most important thing, if you don't want to lose money, is the integrity of the person you back. And integrity is a very, very subjective thing. It is just not the way he treats you, it's the way he treats his employees, his attitude towards complying with laws. It is good business practice to comply with laws. A lot of these people have started their business bootstrapping it. A lot of people don't even know. One of the very successful investments we had was in a milk company called Thirumala. When we invested in the company, if you visited their main factory, you wouldn't give your kids milk ever in their life. There was a smell that went away a mile away. When we sold it, you could have a meal off the floor. But what did we do? We made sure that they set up state-of-the-art pollution plants. We made them spend about $1 million setting up SAP. There were 3,000 farmers from whom we sourced milk, people who had 1, 2 cows. When we sold it, we were sourcing milk from 50,000 farmers. We opened bank accounts for all of them. We worked with state-owned banks to make sure they get loans, et cetera. So it becomes very, very important in accessing these markets that you have people who have deep local knowledge. A person may be beautiful, but if the person has infectious disease, you won't come to know of it unless you're local. The background of the person, how it is, what it is. And this is where one could make a key difference. So alpha is there to be made, to answer the question. There are obstacles because, you can't go to heaven without dying. So, you got to overcome that. So there is hard work. You have to be very rigorous, thorough. You have to keep verifying till you part with your money. And I think there is enormous scope in funds like ours, in working with multilateral agencies like IFC, et cetera. We have co-invested with them in a lot of investments. One of the early private equity deals I did in when I started my career, IFC gave both debt and took equity, and they were on the board. And I think it is a combination of these things that make a difference. I think we perform a very important function because free markets, more than anything else, have taken people out of poverty. And for free markets to succeed, I think it is important funds like ours that provide equity, people who provide debt, work to certain core values. We have an economic interest, we want to make money, but we have to be change agents in changing these countries. You know, things like corruption, things like pollution, things like saving the environment. We got to be very, very conscious of it. And I think with our body of knowledge, network of relationships, et cetera, we can make this change.
Well, thank you very much. My name is Ilgar Veliyev. I'm president of American Chamber of Commerce in Azerbaijan, which represents, in fact, more than 85% of the foreign investment made in the country. And we have about 280 members, so I could speak on behalf of the companies who have already invested in Azerbaijan and after 20 years are still very successful in this country. So to answer the question which you posed, you have made a very great analogy about the optimism, pessimism, and a glass of water, whether it's half full or half empty. To me, what is most important, that there is water in the glass, and that's what we need to concentrate on. And there are opportunities in Azerbaijan, and what we see as investors and the companies which operate in Azerbaijan, that in the past several years, and especially in the last year, Azerbaijani government is implementing an unprecedented scale of economic reforms which aimed at liberalizing the country. And some of them you've been seen already. There are the serious reforms in the customs and fiscal system, reforms in the tax system. There is a big liberalization of the migration and work permits. And the overall attitude towards the foreign investors in this country is great. I mean, I could state an example that we as the representatives of investors in Azerbaijan get meetings with top levels of executives in the country, including His Excellency President, who actually is very attentive to all the issues which investors face in this country. And one of my fellow colleagues said about integrity of people you are dealing with, which is very important. I would like to build a bit more on that and say, in Azerbaijan, what is also very important is integrity of the government. Because of the past 20 years, Azerbaijani government has honored every and single foreign investment contract in the country. None of the foreign investors in Azerbaijan has been either kicked out. We haven't changed any terms of the production sharing contracts which have been signed. And I think it's a very important sign for the investors that the government in this country very carefully honors every commitment it made to the foreign investors. I think that should be a very kind of important factor. And obviously, Azerbaijan possesses a very good level of highly educated workforce. And what my colleague Talek Ziyadov was talking about, Azerbaijan is also very conveniently geographically located, being kind of well positioned between east and west and north and south. With all that, I think there's definitely alpha to be made in Azerbaijan as an emerging market. I think Azerbaijan will not be emerging market forever. Once it will get into the category of emerged markets, and by then it will be too late to invest. So I think it's a good time to invest now. Obviously, yes, there are challenges, there are difficulties. We all see them. We deal with them on a daily basis. But I think without challenges, there will be no return and no certain level of return. So definitely, I think we shouldn't be afraid of the challenges. We just need to deal with them on a proper manner. And I remain very optimistic. And I say, I mean, we've been here my company been here for more than 20 years. And I see the growth of the investment. I see the kind of building confidence. And I think there's some good times ahead of us. So thank you very much.
My name is Andrei Guzvek. I'm the head of EBRD Capital Market Development Team. My background is on the investment side mostly, both investing in financial institutions, private equity, but also as a country manager for EBRD in 2 of our larger countries. Question whether there is alpha to be made, I think the answer is absolutely yes, especially if we seek alpha versus some of the global indices and so on. Obviously, the emerging market universe is very wide. We only operate in 36 countries, interestingly enough. Yesterday, when I flew over here, I was reading the FT fund management paper, and it, on the fund management side, how much is asset under management and so on. It listed all the developed markets. And then it had a tiny little corner, small markets, and that had Russia and Turkey at the top. And I should tell you that these are the 2 largest economies within the EBRD universe. So we really operate in rather fragmented markets. We think that the alpha to be made is largely derived from the low penetration of investment in these markets, and you heard also from Jingdong that their need is actually often greater, even in relative terms, compared to the developed market. But there are obviously challenges, and one cannot look at alpha without looking at beta, that is volatility. One cannot seek alpha without diversifying the portfolio. And thirdly, I think I would echo what was said by the colleague from Carlyle, is that you need to really know who you work with. The human factor and the importance of it is much, much greater in the emerging markets than it is in the developed markets. And particularly it comes out during the crisis where desperate people, you will very quickly figure out, who are the good behavior subjects and who are not so good. Thank you.
Well, thank you, my fellow panelists. I'm very impressed with your succinct but content-rich answers. Let me add IFC's perspective very briefly before I return to my panelists for another round of questions. That is, indeed, from IFC's experience, there is rich alpha to be made. We are a practitioner. IFC has been investing in emerging market for 60 years. The cumulative investment from IFC's own balance sheet is about $250 billion, over 250 billion, about a quarter in equity, the other in debt and structured financial products. And that covers about 120 countries in more than 6,000 projects. And take our latest fiscal year 16, which just finished in June 30th, we invested about 19 billion in 78 countries in 344 projects. Yeah? And in the 60 years, we have never had a financial loss. That is incredible because the nominal credit rating average is single B. So how can you be a AAA institution because IFC's portfolio doesn't have government counter guarantee, like our peers who primarily work in government lending business? So I can attribute it to three factors. Number one is patient capital, right? Given our mandate, we go into an investment with truly long-term view. So when other private sector investors exit, our mandate is not only do we stay, we countercyclically increase our investment in those countries, including advisory services in terms of improving investment climate. The second is global diversification. Now, given our portfolio is global, over 100 countries, there are bound to be places that are in turmoil, but other regions are in good shape. So over time, you balance it out. But the third element is people on the ground. I think many of my panelists mentioned this is truly a people business. I'll give you one factor. In the early 2000s, our investment in sub-Saharan Africa was about 100, 200 million. And we didn't really have people on the ground. Fast forward to now, in the past 5 years, our average investment in sub-Saharan Africa was between $2 and $4 billion. We have 500 people in more than 20 offices. Because you have to understand the local landscape, the pipelines, the stories, the idiosyncrasies that otherwise you wouldn't have. So I will stop there and let me throw back to my panelists, and each I will ask a specific question. And I'll start with Andre. Certainly for EBRD, this region has been under a lot of challenge from Russia to Turkey. How do you make sure that you continue to work with private sector partners and continue to make sure there are investable opportunities that you can provide? What is the risk mitigation role you're playing from an EBRD perspective?
Well, I think it goes a little bit with your earlier question as to what are the top three challenges in terms of investing. And I actually kind of, for myself, listed these three here. And the first one was the local knowledge. You need to have a foot on the ground. You need to have an office. You need to have people that know people and know businesses and so on. I think that's the number one. In terms of maybe risk weighting, I would say that's 80% of your success factor. The remaining issues that come across as impediments to investment, one is obviously FX, and taking risk in a foreign currency is a risky proposition, and hedging opportunities may or may not be around, and the hedging is, even if possible, could be very expensive. And then thirdly, what I would say is this aspect of the smaller markets, i.e. the ticket size tend to be small, and liquidity of your investment is low. I think there are mitigants to that. We, from the EBRD's perspective, we are looking at putting together kind of regional platforms, indices, also inviting some of you to invest. In fact, last Friday, we just had the first close on our equity participation fund, which for the first time ever for EBRD, in fact, enables sovereign wealth funds and pension funds to invest alongside, as passive investors, alongside the EBRD portfolio across 36 countries on a kind of a formula that is pre-agreed in terms of who takes how much risk. I know IFC is way ahead in terms of that with your asset management company that acts as a GP. In case of EBRD, we are the GP, so we take the risk. We deal with the problems as well as share the returns with you.
Thank you, Andrei. To Mr. Viliev, if the Deputy Finance Minister is still in the room, and I have to say, take a step back, that when Azerbaijan was rapidly expanding its economy in the mid-1990s, the country certainly needed all the revenue it could gather for immediate expense. Rather, the country has the foresight of setting aside a pot of money from the oil revenue for a rainy day. And indeed, if not for this rainy day fund, I think the economic impact would have been much more severe. So that's one foresight the government was able to do. But you ran the Chamber of Commerce, which is the collection of private sector players, both domestic and foreign. If you were to ask the Deputy Finance Minister one ask, what would it be to further improve the enabling environment for the private sector?
Well, if I would be able to ask government one thing, I would be rather emotional and just plead them not to stop the reforms. I think reforms have to be continued. It's difficult, it's challenging. Sometimes in a midway, you ask yourself whether I am on the right road. And if the oil price goes back to where it was, I still would think that we should live with the idea that oil price where it is now and continue what we do. Because I think with all the difficulties which we experience now, the situation with the oil price, it's a big blessing for the country because we now have chance to rebuild ourselves, we have chance to look back at what we have done and to get stronger. And one thing I would ask the government, please continue what you do and do it even stronger and continue the dialogue with the private sector, which is very important.
What is the hidden treasure that you can share with private equity investors here that they should come and invest in?
Well, I think I kind of touched upon that. I think geographical location, definitely. I think the level of the educated workforce in Azerbaijan, which is really the penetration of educated people in this country is very high. If you go not just to Baku, but you go travel in the regions of Azerbaijan, you see the level of literacy is very high. And also, I think the attitude towards the understanding of the problems and dealing with them. So we don't try to hide from the problems, and the government doesn't hide from it. They officially acknowledged all the issues which we talk about. Even if you talk about need of the more serious steps, need to combating the corruptions, all this being acknowledged. When the problem is acknowledged, it's much easier to combat it. So I think we on the right path, and I think the hidden treasure is the fact that in this country you could really trust people you're dealing with. Maybe I'm biased, I'm Azerbaijani, I lived all my time here and I will live for the rest of my life, but that's what I would like to share with people. I think you can trust the people who are in this country.
Thank you. Yesterday I learned more than a century ago, an oil baron actually created the first all-girls school in a Muslim country. So certainly there were far-sighted people even a century ago. To you, Shankar, the Chinese engine is slowing down. And in Asia, certainly there is expectation that India is picking up pace. Can you just briefly share what are the opportunities in India for private equity investors in this room?
In India, broadly, there are two broad themes of opportunity. About 84% of the GDP comes from domestic consumption. The rest of it comes from exports. So increasingly in OECD countries, most companies or all companies have to give a better product or better service at a cheaper price and grow their earnings. So consequently, India is one of the countries that benefits broadly from this outsourcing theme. And it's just not IT or IT-enabled services. It could be generic pharma, contract research. It could be textiles. It could be specialty engineering design. It could be specialty engineering. So that would be a couple of $100 billion that could act as a catalyst in the local economy. So for firms like us, with our network of relationships, our investee companies, we can act as a catalyst in helping these companies grow. So we have invested in one of the largest engineering design companies in the world, which has 15,000 engineers worldwide. They design everything from a complex aircraft engine, the latest Pratt & Whitney's noiseless engine, which is a geared turboprop, to shavers for Philips. So they can design everything, and they can design it not because of labor arbitrage, but they can do it better than anyone else. So that is one broad theme. The second theme that you see is you have a young populace, about 60% or so of the people are under the age of 25. So you have rising disposable incomes, greater propensity to spend, a very high savings rate, a very educated workforce. So consequently, you see domestic consumption growing, and it could be in healthcare, in pharmaceuticals, in media and entertainment, in consumer and retail. So a whole slew of businesses. Just China and India are similar. The United States, after the Civil War in a 100-year period, grew and became the most rich and powerful country in the world. You had hiccups like the crash of 1929, but people's wealth improved, people's standard of living improved, and you're seeing that happen in China and India. Just as giant corporations like Coca-Cola, General Electric, Microsoft, et cetera, emerged, you're going to see these giant companies emerge out of India and China. And as private equity people, if we got in to companies where we can act as a catalyst, especially in India, you can make a big change. I wouldn't worry too much about these disruptions that happen in China, or it could happen if interest rates are there. Because eventually, if you took a country like India, there are so many bridges to be made, so many roads to be made, so many people have to have houses, so many people are going to buy cars. So this fundamental growth is there. And once you have the right economic framework, the right economic foundation, I think the ingenuity, the creativity, the enterprise, the hard work of people, with people like us who provide capital, providing the right framework for values, having strong regulators is again good, can be very, very transformational. And I really see great opportunity for private equity investors, great opportunities for firms like us to make use of our knowledge, our strength, to make a return on capital, but more importantly, be a part in transforming these countries and lifting their populace out of poverty and to a better life.
Thank you, Shankar. Mr. Yang, it seems there is overinvestment, overcapacity in every sector in China. But can you actually point out some of the growth possibilities, especially China is transiting from a manufacturing to a consumption-led economic model?
We don't quite see the so-called oversupply or over whatever, because China is really a very big country. As I mentioned earlier, maybe oversupply or over whatever in the first-tier city in Beijing, in Shanghai, in Guangzhou, but you still have the central part of China, you have the western part of China. They do not have access to capital. They do not have access to bank loans. So we provide the growth capital for these companies in the central part of China and the western part of China to grow. Just imagine a province in China, a province called Sichuan in China. You have about 80 million population, 80 million. So we invested in some of the chicken farm. You just imagine whether the economy is slowing down for 0.5%, people eat chicken, right? So we have more than enough projects and companies for us to invest in China. As I mentioned earlier, we are trying to do the similar investment thesis in Russia, in the CIS country. We are looking at the far east of Russia. We are looking at CIS country. We're just trying to kind of replicate our success by using our Chinese experience. 16 years ago, when we were first entering into China, people say, "Are you sure you're going to China?" So I would hope that 16 years later, people will say, you did a good choice of coming to Russia and coming to CIS. So I'm just trying to do that.
Janet, before I turn to you, let me share a little bit of outlook for Africa. As Stella said, Africa, in spite of the commodity impact, there is a rising middle class. Let me just share one number that IFC just published yesterday. That is, in urban Kenya, there is a 20 million unit of shortage of middle-income housing. Just imagine, if you build up a cement industry, if you provide housing financing, there are tremendous opportunity to supply those opportunities to a growing middle class. This is only one country, and if we expand that to the whole of sub-Saharan Africa, tremendous opportunities. That's why we have ramped up our investment in sub-Saharan Africa from a couple of $100 million to, $2 to $4 billion. In Nigeria alone, each year we invest over $1 billion. So tremendous opportunity. Be very happy to connect with you in terms of partnering in private equity investment in Africa. But Janet, I wanted to ask you about ASEAN. ASEAN has 600 million people, yeah? Also a bulging middle class. So do you have a specific strategy in private equity, in private sector development? What are you doing in supporting ASEAN's private sector growth?
Yeah, so for ADB, our strategy is very much focused on providing growth equity. So we're very much targeted, obviously, in building up the SMEs, which is why in the last 20 years, most of our 60 funds have been geared towards the SME enterprises and also in the lower middle income sectors.
All right, I think we have 5-10 minutes for Q&A from the audience. Please.
Thank you. Israfil Mamada from Sofas. I would like to express thank you to panelists. It was an exceptionally interesting panel. My question is to Mr. Yang. What would be the top 3 challenges investing in China? Thank you.
What are the 3 top challenges of investing in China?
The first challenge, I think, is the same as what Shankar has mentioned. I have mentioned, we took minority stake in the company. So the management, the integrity of the management, that's number 1. The second challenge would be choosing the right sector to move in. Because we are considered a foreign capital in China, there are certain sectors it's all about for us. For example, the top stream of energy sector. The third challenge will be what we have done well. Maybe I don't call it a challenge, is how to plan our exit. We plan our exit before we enter into any portfolio companies. Maybe first, the most important thing, I think I would touch on the management. If you have time tonight, just search my TED Talk. I have how to do your due diligence in China. And then if you have questions, send me email after watching my TED Talk.
Thank you, Mr. Yong. Any other questions? Well, if not, if I could ask my fellow panelists to make your concluding remarks, anything that we missed in terms of a general message to the audience who collectively may have trillions of dollars of potential investment in emerging market. What would be the message from your particular institution to them? So we'll start with Andre.
Well, first of all, I think that the double whammy of ultra low interest rates and the QE has affected the emerging markets less directly. And the asset prices have not quite, been pushed to the levels of the developed markets, so the PE is lower. I also feel that there is a lot of potential value being created through the reforms, and that includes, capital market reforms where Many of these markets have been very bank-dominated, and now other investment alternatives come about. And then finally, there is still quite a lot of room for the state-owned enterprises to come to the market, either public market or private market. So I would look out for these opportunities.
Well, I kind of mentioned my suggestions already, so in order to save the time, I will pass to another panelist.
Yeah, I would reiterate some of the points I said. In terms of integrity, how is it that you figure out whether someone has integrity or not? We spend a lot of time. I personally would go meet a guy's grandmother, his wife, his kids, in unstructured settings to get an idea of the kind of person he is. And it becomes very, very important that when we have local talent and when we are in the market, we set the standard very, very high. The second thing is firms like Carlyle, I think, who have a great body of knowledge, a great network of relationships, can really work together with these companies to make a transformative difference. The companies that I invested in when I started my private equity career, small sums of money, they are companies that are worth, in certain cases, a couple of $1 billion, in many cases, several $100 million. So these businesses have changed. It's created employment, it has changed people's lives, it has made the entrepreneurs wealthy, but more important than anything else, in each of the countries we work, whether it is China or India, anything, it has uplifted people's lives. There is no shortcut or no magic to it. But as owners and providers of capital, I think we bear a huge responsibility to make sure that this capital is deployed productively. Because if this capital is destroyed, given to a person who's dishonest, a person who's on a foolhardy mission, you're really depriving some other entrepreneur of capital that could create jobs, could create wealth, and in many ways be transformative to the countries. So it becomes very, very important that we set the standards of rigor in doing it. We are deliberate about how we deploy the capital. And the third thing is investors like to see returns. So exits are very, very important. So as investors, if you're IFC, probably you have a longer time frame in terms of money. Patient capital, funds like ours probably have a little shorter time frame, but we tend to remain invested for between 5 and 7 years. IFC may be longer, but it is very important that liquidity is there. And how do you get liquidity? By building world-class companies, and at the same time getting people interested in it, making sure that in each of the markets we operate, we create a market. Because eventually liquidity comes if you can list the shares, if you can get a strategic interested, and that is the way you go to the next level.
I share the same sentiment as what you have mentioned. Maybe the only thing I want to add is we choose the project. If the project didn't work out, I think we don't put the blame on another party, put the blame on yourself. So this is what I always have to tell myself on that.
And so for ADB, so we obviously know there's a lot of capital out there in the market. We see it with our donor agencies, obviously with the pension funds and the sovereign wealth funds. So I just encourage you to really partner with the established fund managers out there who have on-the-ground presence and with multilaterals, because it does allow us to incubate new funds and also target sectors that are critical for development and also achieve both the commercial as well as the developmental objectives.
So let me end by telling you a story of the role that we can play as multilateral financial institutions. So when Afghanistan was liberated from the Taliban, some of our development institutions seated here, I wouldn't mention name, thanks to that participation, we had Middle Eastern private sector sponsor who came to Afghanistan and created a telecom company, a cell phone company, yeah? Otherwise, nobody would come to Afghanistan for a private sector investment. Company is very profitable, doing well, and the government wanted to nationalize it. Yeah? So I think the message from us as development bank to the government is that you need to back off, because otherwise, what little attraction that you get will be totally destroyed, that no private investor would come to your country. And the government listened. So our job as multilateral development banks are twofold. Number one is that we are here to use our billions to crowd in the trillions needed for private sector development in emerging market country. Number two, we are here to risk mitigate, but more importantly, working with government in laying out the regulatory framework, transparency, the enabling environment, the capacity building. So truly look forward to working with all of you. I think this is a rapid fire, but a very interesting discussion. I wish it could have gone longer, but I realize we are the last panel standing between you and the nice dinner. So let me stop here. If you can join me in thanking our panelists for a terrific discussion. Thank you very much.